Max, I've asked this question a few times in the last 24 hours. It's your turn. Are you feeling more or less confident after that tie-up yesterday?
I feel probably more confident. I feel also more confident after what's happened last week. I would feel much more concerned if indeed if we had perhaps sentiment and positioning much less really downbeat. Now, I've been listening to your show for the last eight minutes, and there's not been a lot of positives yet, right? And I think that's a fair understatement if I say that. And that's the good thing. The good thing is when we look at survey-based sentiment, that's pretty depressed already. If we look at technicals, right? So like relative strength across risk assets, already very depressed. VIX term structure sort of down to below the 10th percentile already, right? When we look at equity betas of multi-asset funds, down, right? When we look at put-call ratios, not only in equities, but across the asset classes, sending clear bearish risk sentiment signals. So the good thing is, right, with all what's been happening, not only in the last 24 hours, but really over the last week, is that sentiment has gone and has derated sufficiently really to bearish levels that I'd be very careful to throw in the towel on constructive views now, right? So we've just put out a note and said, look, we're still holding on to that constructive view because indeed, the sentiment and positioning really across the board looks much more negative now, which is a contrarian positive signal.
Max, let's put a bit more specifics around this. Are you saying right now you're going out there and buying European banks to move counter to the zeitgeist that we see out there?
Yeah, I think so. I think banks are more and more looking actually attractive. If we look at, the relative performance perhaps of banks over the broader market, look at the performance of banks over tech, for example, that is back to the COVID highs, right? That's back to where we were at sort of the dizzy heights in 2020 when, real rates were down to almost record negative levels. When we look at the broader banks' performance, not only in Europe, but also in the US, when we look at that against, US Treasury yields, if we look at that against financial conditions in particular, it's priced right now for the second sharpest deterioration in financial conditions already, right? So there is an awful lot in the price, particularly from a relative perspective already, right? So I wouldn't say, oh, nothing's happened yet, and there's much more deeper pain to come. We're getting pretty close to pretty attractive entry levels, I think.